Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And this week I think we need to focus on the US economic data. There wasn't a lot of South African data produced last week. And even the US data, there were gaps because of the partial government shutdown, in particular the main labour market report that should have been out last week, Friday, that's been delayed. So I think we'll pick up on that report when it's out. I assume that will be out fairly soon. So the US data really focused on the ISM manufacturing index, which I think had a very interesting development for the January number. And then we did get some employment data, which I think is worthwhile recapping. The South African data, there's quite a bit coming out this week in terms of production updates, manufacturing, mining type updates. And obviously we've got the mining in Indaba, which is a big event by global standards. So there may be some interesting developments that emerge from the mining in Indaba. And then we've got the South African State or Nation address by the President. And hopefully there are one or two new initiatives that are worth focusing on within that speech. So a bit to focus on over the coming week, but I think for the moment a fairly short recap on what happened in the US last week. So let's start with the US ISM manufacturing data. The numbers for January were released last week. And the reason why I think it's in focus is that there was a massive improvement in the index. At a macro level, it increased from a reading of 47.9 in December all the way up to 52.6 in January. And as we know, anything about above 50 signifies an expansion within that sector. US manufacturing has been under quite a bit of pressure for a number of years, and it's been really struggling to gain momentum. And now suddenly the number looks compellingly better. And if you drill down into that data, the important new orders index jumped also very substantially, suggesting further activity in the months ahead. So we need to understand what caused that massive increase. And from my perspective, unfortunately, I don't think it's reflective of a longer term improvement in US manufacturing. I think it reflects more the fact that people were worried back in January that President Trump would implement additional tariffs against Europe, particularly in response to Greenland, and that there could well have been some preemptive orders placed or some preemptive buying ahead of that potential threat. The other dynamic that I think is at play is that many businesses would recognize that over the next couple of months, US consumers are going to have more money in their pockets because of the tax rebates that form part of the One Big Beautiful Bill. And those tax rebates are going to be significantly larger than what would normally occur at this time of the year. And so you would expect that consumer activity will pick up. And clearly, if you don't have the right sort of inventory level, then you're going to miss out on that. So it's entirely feasible that various orders were placed in anticipation of that spending phase, which will start to occur in March and probably carry on for a couple of months as the rebates are cleared and consumers have a bit more money. Outside of that, the other key economic data was kind of the opposite of that, and that's the weekly jobless claims and the job openings. In other words, some of the US labor market data, and in general, those numbers came across as being fairly soft. Now, we've seen the US labor market soften in recent months. By that I mean the US economy is not adding nearly the number of jobs that it did in earlier years, and there's clearly been a holding back of new employment by many businesses. The reason for that holding back, I guess, is policy uncertainty to some extent, just generally a bit unclear about where the tariffs are going and other policy initiatives from the Trump administration. But there would also be some holding back because of AI development. In other words, you don't want to go and add a whole lot of new staff, particularly young new entrants, into your company if you're simply going to be adopting an AI initiative over the coming months, coming years, that will substantially disrupt your internal business process and may in the end require that you don't need as many employees. So I think there's a little bit of holding back in terms of the labor market, and so you would say that generally labor market conditions have softened. Now, if I look at the data that came out last week, it tends to confirm that. The job openings fell. It's still 6.5 million, so still a very sizable number of job openings, but it's been moving back down over the last couple of years, and particularly in the latest round of data, there was another sharp move to the downside. So a clear indication of some weakness in the labor market. And at the same time, if I look at the weekly jobless claims, there was a spike up in that week, suggesting more people filing for unemployment insurance. To some extent, I think that actually was affected by poor weather. The US has experienced some quite extreme snowstorms, which can typically affect the weekly claims. But even taking that into account, it does feel like that number is a little bit softer. It doesn't mean that US companies are cutting a significant number of jobs. There's very little evidence of that. But there is evidence that the US private sector environment is just not adding the number of jobs that it used to, and so it feels as if it's trending or moving mostly sideways. And that's fine to some extent for the US economy. It can continue to grow at a decent pace, around 2%, even if it doesn't add a significant number of jobs. And it's only really if you get substantial job losses that you would worry about the US economy slowing appreciably or going into a recession. So the fact that they're not adding jobs is not a crisis, but it does signify that the US economy is not as robust as it has been in earlier years. And I don't think at this stage that that is about to change. So our anticipation is that we'll see a general softness to the labor market throughout this year and into next year, but I'm not anticipating that it goes from a soft labor market into something a lot weaker. That is the clear risk, and we need to pay attention to it. But for the moment, as I said, I don't think there's any clear evidence that that is likely to materialize. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.